Okay. Hello, I'm testing the English channel. This is the test for
va a responder. días a todos los asistentes que nos acompañan.
Good morning to all attendees at this FLAR webinar. Welcome to this webinar titled The Impact of Financial Crisis on Industrial Growth, Lessons from the Last 40 Years. This is an article that was authored by Carlos Madeira, senior economist from the Bank for International Settlements and the Central Bank of Chile. In order to discuss this article, we have Marco Vega, Deputy Manager of Economic Research from the Central Reserve Bank of Peru. Thank you very much, Marco, for accompanying us. The subject matter of this article is quite relevant to the current setting, which is characterized by high uncertainty, growing fragmentation, and clear geoeconomic reshuffling that is redefining value chains and capital flows. These factors, coupled with the pandemic aftermath, have put to the test the resilience of our economies. Against this volatile backdrop, understanding financial disruptions, especially in times of crisis, pass on to the real economy, particularly the manufacturing sector, in order to create public policies that may foster economic growth to guarantee macroeconomic and financial stability. In the case of Latin America and the Caribbean, this is particularly important because, historically speaking, our economies were subject to financial vulnerability and shocks, experiencing big shocks due to external finance and FX crises. Against this backdrop, the article points out how macroprudential policies adopted after the 2008 GFC has been instrumental to offset these negative impacts. So let me welcome Carlos in order to throw color at this very interesting research work. Thank you very much, Yaider and Marco, for having me. Let me share the presentation with you. Good. This is my article, which I have been working on for the past year. This work has already been published. Therefore, we are going to talk about macroprudential policies applied over the past 40 years in the manufacturing sector. As for the effects of financial crisis, this is hard to study due to reverse causality. I study GDP and growth, but it's very difficult to decide whether GDP affects policy or whether policy hits GDP. In this particular case, I'm going to talk about the effects of financial crisis on 23 industries across 102 countries, 35 being developed economies and 67 being emerging markets and developing economies during the past 40 years. This previous work was carried out by De La Richa and et al., but it was limited to fewer countries and a limited time period. They did not cover the 2008 GFC nor other that took place in recent times. In talking about reverse causality, we have identified some exogeneity assumption. Therefore, these industries are small companies accounting for 0.32% of GDP on average, with the median total manufacturing sector accounting for the less than 3% of GDP. In the case of countries such as China or Mexico, which are key manufacturers, the manufacturing sector never accounts for more than 25 or 30% of GDP. In addition, manufacturing industries are not a representative agent. Their correlation to GDP represents a 42%. Therefore, they are relevant to the real economy, but they are not a main source of concern for financial stakeholders, and they are not a representative agent that may have an impact on the decisions made by regulatory agents. Could you please speak up because there is some background noise, says one of the attendees. Actually, there is one person's microphone that is on and should be turned off. If you speak up a little bit, maybe we can hear better. All right. What about now? Please go ahead. Thank you. Otherwise, I can change my laptop computer, but I will be wasting time. Maybe there is somebody talking in the background. But if you speak up, it's going to be better. So going back to the financial crisis, I'm going to refer to Levin and Valencia when talking about banking, currency, or foreign exchange and sovereign debt related crises. As for real growth of industry, we have considered the country represented by C and the year represented by T. According to the United Nations Industrial Development Organization, my article has been disclosed publicly by both the UNIDO and the IMF. So this is how I calculate real growth in each sector, and I establish an interaction between the effect of financial crisis with the external finance index and financing for each manufacturing sector, and I also apply other controls, which are commonplace. For example, the share of each industry in the economy's aggregate value, in addition to GDP per capita and fixed effects, which is represented by country industry effects, as well as country year effects. The analysis refers therefore to country industry effects and country year effects, as well as industry year fixed effects. I also established the effect of macroprudential policies reported by many countries after the global financial crisis. Okay, this is the external finance dependence index according to Rajan and Zingals. We assume that you have to use this formula for banks, markets, and other external financial agents. However, in the case of many industries, you have to take into account capital expenses, cash flows. Therefore, if cash flows are inexpensive over this function, we will have capital expenses that need to be financed by external investments. Next, We have other checks, for example, the added value base, GDP per capita, inflation rate, a growth rate, or the monetary policy of each country. Next, I'm going to introduce the findings of the OLS panel. This is dynamic with some fixed effects, as well as some variables such as value added share. All these findings are robust, and as I mentioned in my article, I mentioned the quantile regression with fixed effects according to Machado and Santos Silva. Next, we have sizable effects on dependent industries, which is normally below zero, and this is represented by EFD. The main result is that fully external dependent industries suffer most during banking crisis with a growth reduction of 3.4%. According to all the countries in the sample, almost 0.8% in AEs and almost 7.5% in EMDES. Therefore, industries in emerging markets and developing economies are the ones that suffer the most during banking crises. The same applies to currency crises. As for currency crises, they are normally worse than banking crises because they bring real growth down by 4.9% across the countries in the sample. Now then, these are the manufacturing industries that we have considered for the purposes of the study, 23 all in all, and their external finance dependence. For most industries, external finance dependence is positive with a median of 0.28 and an average of 0.34. However, there is ample diversity that goes between 0.03 to 0.26, and some industries are 100% dependent on external financing. This is the key regression for all countries with macro controls, fixed effects in terms of country, industry, and time. These are the main findings. The banking crisis and its interaction with external finance leads to this percentage of minus 3.389. This corresponds to industries with full external finance dependence. That is to say, industries that resort to markets and banks in order to finance their capital expenses. There are only 3 industries under this condition, but in the case of the others, they are also negatively affected. In the case of EMDES, we talk about 7.502%. In the case of developed countries, it's not very significant. We can now take into account fixed effects, taking into account time and country. Therefore, all macro policies adopted by the country happen to be robust. In this case, this is considered because we also applied time effects for the different countries, taking into account time effects as well, and similar results were reported as for the country's regression baseline. These are therefore the results from other financial crises. I'm going to focus on the very last column, column number 3. That takes into account all types of financial crises. This means that any financial crisis will bring growth down in the case of industries that rely on external dependence, with a reduction of nearly 3%. In the case of a currency crisis, we're talking about 5.086%, and in the case of sovereign debt crisis, the effect would be minus 2.858. Therefore, currency crises have a greater effect compared to banking crises, as you can see in column number 4, which shows all crises at the same time. The banking crisis with lower growth, with a reduction of nearly 3%, and the currency crisis having an effect of a 4% fall. As for the sovereign debt crisis, it's not statistically relevant, even though it becomes more relevant if we add up all other crises. These findings are robust when taking into account fixed effects, industry effects, country industry effects, and industry gear effects. These columns correspond to emerging markets and developing economies. We see a significant result both in the case of currency crisis and banking crisis, and this normally happens in emerging economies and developing economies. As for developed economies, no significant statistical data were found. Next, I'm going to talk about regressions applied to industries in every country. If we take into account the manufacturing sector in each economy, we have to take into account that in each country, there is a different weight for each industry. Therefore, we are going to calculate the effects taking into account that industries report a different effect in each country. And they also behave differently over time. It depends on whether we're talking about tobacco or any other industry that may have a different kind of impact on the economy over time. So I'm going to talk about the impact of regressions over the past years for the different countries. This slide shows some of the results. Regarding the banking crisis, we see a decline in growth of nearly 1%, 0.8% to be precise, in the manufacturing sector, taking into account all the countries in the sample, with a 0.5% in the case of developed countries. As for emerging economies, we see a fall of nearly 12%. As for currency crisis, the effect is nearly 1.3% across countries, with a positive value in the case of developed countries. So which are the statistically relevant data in the case of developed countries? Perhaps currency crises have a positive effect on developed countries because of this. Another possibility is that developed economies tend to be more competitive whenever there is a currency crisis, and their foreign exchange rate therefore goes down. However, the effect is bigger in the case of developed countries and emerging economies. The same happens with sovereign debt crisis. These are the effects. It's negative across the economies and a little bit higher in the case of emerging economies. This is the total effect of financial crisis on manufacturing growth. The effects I'm presenting are the ones resulting from financial crisis from external finance dependence channels. However, one might think that financial crises have two channels, a financial channel, which is shown here, and the total channel. And therefore, this has an effect on demand. This is the total effect. During banking crisis, there is an effect of nearly 3 points over GDP. However, during currency crisis, we observe such negative effects across countries, mainly in developed countries. However, this is higher in developing economies. And as for sovereign debt crisis, the results are particularly significant in developed economies because their sovereign debt is higher, and therefore the effect of sovereign debt in the financial channel is not big. However, the financial effect is big in terms of the impact on the economy. These are the effects during financial crisis during the period prior to the global financial crisis back in 2008. Both banking crisis, or in banking crisis, the growth of countries goes down by 4.6 and 4.4% respectively. During the GFC, there were many countries that were impacted. The effect was greater in the case of emerging economies. These are banking crises that took place after 2010. Therefore, after 2010, banking crisis reported a significant effect in developed countries, whereas in emerging economies, banking crisis did not have such a big impact. This is the post-GFC effects in the past 10 years, if we take into account macroprudential policies. This is what happened in the manufacturing sector when macroprudential policies were implemented. And this is what happened across countries as well as in emerging economies. These are banking crises with fiscal and monetary policies. The slide shows that monetary policies, whenever normally do not have a significant effect when there is a reduction in manufacturing growth, or the impact is not big enough to counterweigh the total effects of financial crisis. However, monetary policies do have an impact. This is a negative coefficient. All countries, including emerging economies, however, as monetary policies decline, the ultimate effect on growth is positive. Okay, I'm going to stop here. I believe that we are on time so that we can open the floor for questions and comments. So here are some conclusions. Banking and currency crises have an impact on all externally dependent industries, especially in emerging markets and developing economies. Currency crises are even worse than banking crises. Currency crisis was mainly on developing economies. In addition, in the case of EMDES, almost all the effect of banking and sovereign debt crisis comes from the external finance dependence channel. As for developed economies, the effect of financial crisis arises from financial channels. Monetary policy is effective, yet not enough. It falls short when it comes to counterweighing the effects of financial crisis. The overall analysis is robust. It has many fixed effects, taking into account country industry effects and industry time effects, and taking into account uh, quantile regressions based on fixed time effects. So we can open the floor for discussion. Thank you very much for such a thorough presentation. Carlos, we see many microfinance, and we believe that this applies to the current economic context. In order to discuss the subject matter of this article, we have asked Marco Vega from the Central Reserve Bank of Peru to join us. So, Marco, you have the floor to comment on Carlos Madeira's article. Good morning. Thank you very much for having me to talk about this work. I believe, yes, we can hear you all right. So I find Carlos Madeira's work very interesting. It's a thorough piece of work for the entire region. So I have taken some notes about the working paper by the BIS. I believe that it is a latest version, but according to the BIS working paper, which I have been able to review, well, actually, this article is very similar to that working paper. I believe that some of the graphs you have shown are pretty similar. I believe this covers the entire presentation. With regard to the methodology, I find that you have used significant databases. I have used some of the financial crisis databases of the BIS. This is a significant source of data. I believe that the article covers 23 manufacturing industries across many countries. In 102 countries between 1980 and 2019. So the baseline model is a panel model where several controls are used, such as inflation rate, foreign exchange. But growth is at the core. Growth taking into account crisis and then the interaction between crisis and macroprudential policies. And EFD. So the model is adequate according to this database. Then some robustness controls have been applied. I believe that robustness is critical to the study. We should discuss the scope. That is, financial crisis on the one hand, and then macroprudential policies or monetary policies, the effects on GDP and how much damage can financial crisis cause. The manufacturing sector seems to be particularly affected by these crises. The manufacturing sector is just one sector in economies. I understand that some of these data are limited. I believe that you spoke of nearly 13% of GDP. 13%, that is the median value. But in some countries, it goes all the way out to 30, such as Mexico, China. In those countries, it may come close to 30. So maybe in those countries, the effect is bigger. There are other countries which are more focused on the primary sector. This could be or could provide the groundwork to analyze the effects that financial crisis might have on other productive sectors that may happen to be significant sectors. There are additional data. I believe that you have prepared a study of the effects of investments on certain sectors, such as primary sectors or extraction economic sectors that may be hard hit by financial crisis. Currency crisis may be lethal, but this is not surprising. They may be lethal to economies. This is connected to macroprudential policies. Now, foreign exchange intervention actions by central banks and FX buffers are considered to be macroprudential policies, and this is all critical. Carlos, you showed one graph depicting the effects of the post financial crisis. I believe that you showed this green bar indicating that the effect on GDP. I don't know if you could show that graph on the screen again. The counterfactual exercise. In fact, this exercise, counterfactual exercise, I believe that this is new and this information was not included in the working paper. I prepared the graphs myself. Therefore, we tried to provide this graph in order to be more clear from a communications standpoint. I believe that the effects in emerging countries have been positive when policies were applied. Is that right? Had you not applied macroprudential policies, the effects would have been significantly negative. In fact, says the speaker, I believe that this is too good to be true. Uh, mm, Growing amidst a financial crisis is quite peculiar. If we applied some kind of confidence range, it's difficult to count on a negative effect, but it's kind of surprising that the effect was positive. In fact, I would have to decide how to do that, but the graph would be more complex if I arranged these columns or these bars differently. This depends on the degree of confidence that one would apply. So I find this exercise very interesting, Carlos. In a nutshell, this is the key finding. The most important effect or the most devastating effects derive from currency effects, with a 6% effect to be precise, followed by banking crisis with a 3% effect. This is not so devastating, but nonetheless, they do have an impact. And finally, we have sovereign debt crisis with these effects. This is the total effect. This is the total effect because this corresponds to the financial channel only, whereas this corresponds to total financial crisis channels. Furthermore, sovereign debt crisis effects happen to be greater in developed countries, as we find in Central Europe. So, from a results standpoint, I believe this study is very significant because it ratifies beforehand knowledge that we already had. I believe that all these exercises are key and they serve as a policy guide. This also shows the effects of macroprudential policies because they attenuate negative effects, mainly in emerging economies. I believe that policies make a significant contribution. Nonetheless, we have to consider that these are limited data because we're only taking into account the manufacturing sector. In fact, I have identified many industries, but I have actually done the same for all sectors, but only in the case of OECD countries. This would require a different approach. This study concentrates on developed countries and other countries such as Mexico or India, which are not highly developed countries, but have been included in the study nonetheless. We may find a high degree of heterogeneity in emerging economies and developed countries. Mexico has its own manufacturing characteristics, but then faraway countries relative to the United States may have a different structure or a different manufacturing structure. Distance to China or similar countries behave differently if we take into account those countries that export commodities. Therefore, this may be one heterogeneous factor that we may detect. In order to carry out the same analysis under the same framework, we should consider more heterogeneity in more countries and in emerging economies in order to further enrich the study. All in all, however, I believe that this is a very interesting working paper, and I hope that it will be published shortly. Thank you very much for your comments, Marco. Thank you. Yada, back to you. Marco, thank you very much for commenting on the methodology and the subject matter of the article. Carlos, would you like to make any additional comments before we give the floor to questions? Is there anything that you could like to add about Marco's remarks? Well, Marco's remarks were very precise. When receiving anonymous reports, I normally review all such reports and any comments that we may get from different seminaries. I believe that I'm going to include the articles that you have mentioned. The graphs are shown on a table at the end of the article, so maybe I should remove the table and include the graphs at the very end of the paper. In fact, all these results are rather limited. On a median scale, the manufacturing sector accounts for 13% of GDP or less. In highly manufacturing countries such as China, it may not even reach 30%. I do have an alternative piece of work which is limited to WACDE because they have considered 80 sectors, but then we have another problem, and that is that the sample will be different, totally different, because it would include few developed and emerging economies, only 50 countries show high or medium income levels, but I will take into account all the comments I have received. I believe that Yada has additional comments. Talking about external finance dependence, Arsenal Igales obtained some data in this respect, but there are other alternatives. Somebody has already estimated data up until 2016. I experimented with more recent data with similar results. The paper considers volatile values broken down by industry for recent times. Above 1, however, the results continue to be significant. if we use a unit value plus 1 plus a 0, for example, we may come out with a different result. So what are we talking about? The EFD index calls our attention because we understand that this article is based off a lot of data. We are talking about 102 countries having been considered. This therefore requires granular work, and that's why the article is so important. Now, the EFD index pulls our attention because it's at the very core of the results of your study. Therefore, it would be interesting to understand whether the way in which companies manage financial crises may worsen such crises. This is based on an article published in the late 90s and that was concerned with the manufacturing sector in the United States. Now, this EFD index seems to be fixed and applies to the overall period under the study. And it corresponds to the US manufacturing sector, which is expected to have a particular behavior. When talking about external finance dependence, we may think that in the United States, companies may require less external finance. Now, what do you think about extrapolating those results from the article published in the late 90s concerning the United States to developed economies and emerging economies, assuming that financing requirements by the different industries are similar in the United States compared to other countries? Thank you, Yada. Well, going back to Reggian and Zingales' study, this index is an industry parameter. And that's why it applies to US industries for this coefficient or ratio not to be affected by other frictions or by deficient technologies or other developments. So it seems to be the most appropriate methodology for Reggian and Zingales. That's why they have applied the EFD index of the United States and they have extrapolated that to other countries. Since we have capital expenses and cash flows that may be affected by financial crisis, I believe that we could use data from the period before financial crisis. Sometimes I use other values for other countries. Therefore, there is another recent piece of work that includes France, Canada, Germany, and the United States, but it covers only the period until 2016. We can also use other financial friction factors according to Rajan and Zingales, which are not only determined by cash flows or capital expenses. They take into account the age of the company or the industry, among other factors, resulting in other effects. Now, going back to emerging economies and Latin America, I believe that the sample is narrowed down when we try to analyze this EFD index, looking into each country and when analyzing external debt levels in non-financial entities. Prior to the COVID-19 pandemic, we observed a high level of external debt, which might result in a currency mismatch. Therefore, the question based on the paper and concerning banking crisis, maybe we should assess that level of mismatch or over indebtedness relative to the international financial sector so that we can see how manufacturing sectors may be affected. Maybe this affects particularly Latin America or emerging economies due to currency crisis experienced in the past. Maybe the policies that we have been discussing might be a solution. The purpose was to show other channels and effects, as shown by this FT, which shows time effects that apply to all countries. For instance, the Volcker crisis is included here, the same as the GFC or the European sovereign debt crisis. They are all factored in here. So this could be included in the main regression. I didn't follow that approach because I intended to add further factors. The main result is robust. So rather than exploring other financial channels, I wanted to show that the analysis was robust enough. So here we have the country industry effects, the industry time effects. In this case, it would no longer be possible to identify something that is specific to a particular country in terms of time. We believe that these may have heterogeneous effects across industries. Coefficients remain unchanged, and those that apply to each industry show a high degree of robustness. This is very important. So fixed effects factor in all prior frictions. This is counterfactual to the GFC that hit us recently, the same as the COVID-19 pandemic. Now, if we think of Latin America, we may tend to believe that the 80s and 90s were different periods of time compared to 2010 or 2020, when different macroprudential policies began to be implemented. Did you try to draw a distinction between periods, taking into account the policies that were implemented in the region during that term? One may think that these are two different worlds that we are evaluating. If we compare data from 1999 and subsequent periods, this was supposed to be an international study. So we know that the 80s were important in Latin America. The 50s were important for Asia and Mexico. 2010 was an important period for Europe. Therefore, the only distinction that I drew was the one of the 2008-2010 GFC. I did not include other periods, so I apologize about that. I cannot answer, therefore, based on this article, I will have to do so in the future if I prepare a paper on Latin America. There's something else that calls my attention in your article. You highlight the relevance of macroprudential measures to mitigate financial crisis effects. And these are very robust results that you are reporting. And other macroprudential policy Studies show that these measures are important in order to counterweight the effects of financial crisis in emerging economies and particularly in Latin American countries. Some authors claim, however, that these may come with some costs for the manufacturing sector because financing may be restricted. You also mentioned that in your article. Can you speak of the trade-offs and how can this be positive? Do you have any evidence showing that macroprudential policies, regardless of the costs that they may bring about, may eventually have a negative effect to counterweight the effects or aftermath of financial crisis? Yes, of course. I do not have the exact formula in this presentation. Nonetheless, I have included the effects of the financial crisis plus macroprudential policies and the effects of external finance dependence, financial crisis, and macroprudential policies. I analyzed that framework and I came up with this result. Afterwards, I used the same model taking into account all macroprudential policies equal to zero. There were no macroprudential changes during the period, and that's how I came up with these results. I know that this coefficient shows a significant difference that is positive, but the reason is that the model is characterized by some coefficients that are not clearly identified, and countries normally change their macroprudential policies quite often. Macroprudential policies uh, changed after 2010 up until 2008. The macroprudential framework remained flat as of 2010. We begin to see countries adopt macroprudential policies on a regular basis. This is an estimated effect based on this 10-year period. But however, we need to analyze a longer period in order to increase the scope of confidence related to the study. I have one final question, Carlos. Many attendees are asking whether you have any recommendations concerning economic policies and which are the main macroprudential measures that could be applied to countries in the region. But in order to provide a more generic answer, not sticking to a particular country, what could you say about the main lessons or the economic policies that you would recommend on the basis of your article? With respect to Latin American and Caribbean countries, taking into account the current global and regional context. Thank you very much. Excellent question. As you are saying, I have results for specific countries. My results are country specific. Nonetheless, this is related to those countries that have monetary, fiscal policies, and macroprudential policies in place that act as a safeguard. Therefore, you may build up tax or positive tax balances that you can use in times of economic downturn. Otherwise, when a crisis hits, if you do not have that safeguard, it may be a problem. I believe that Latin America did this quite well during the pandemic. And that was quite surprising, even to many around the world. The Latin American region performed well during the past crisis because the countries had good fiscal weapons in place. Chile, for example, did it very well back in 2008 and 2009 when they had added up all the tax balance, and in 2008 when the GFC struck Chile, they stood strong. So those are some of the lessons for fiscal policies, and the same applies to macroprudential policies. Here you can see how the manufacturing sectors were affected during growth periods, but during financial crisis, you can apply macroprudential policies in order to lessen the effects of the financial crisis on the manufacturing sector. So this is the main takeaway lesson. There are different policies, but the effects thereof cannot be easily assessed. Over the past 10 years, macroprudential policies have changed. I've always obtained positive effects, but if you take into account confidence intervals for the different policies, it's hard to identify policies that may be stronger than others. Perhaps the loan to value policy is the strongest one, but that is mainly targeted at consumers. Many companies tend to take out loans in order to finance their own growth. Maybe that is perhaps the strongest kind of policy that may be applied. But I believe that confidence intervals vary from each macroprudential policy to another. That's a good analogy, Carlos. Fiscal and macroprudential policy correlations. Well, unfortunately, we have out of time, but before we close, I would like to extend my appreciation to Carlos and Marco for their excellent presentations and comments on this very interesting research work. I would also like to thank all attendees for having joined us at this FLAR webinar, and we look forward to the next webinar. Thank you very much. Thank you all. Thank you, Yader and Marco.